Hi everyone, Isaiah Rial here. Good morning or good afternoon. In this video, we're going to talk about how to make an aggressive portfolio. So we're making the most aggressive portfolio that we can create for ourselves as investors. In this video, and more so actually in this portfolio as an investor, we're going to take the maximum amount of risk in the hopes that the risk we're taking is going to reward us with high returns down the line. So we're willing to put all of our chips into the basket. We know that we may lose some or all of our money, but as an investor, our thought process is going to be that, hey, we're willing to take the maximum amount of risk for the hopes, for the chance that that risk we're willing to take is going to reward us with high returns down the line. So we're going to be invested into all equities. For example, stock or stock funds in this type of portfolio. So in the video podcast, I'll share with you how we create this portfolio, what's the investment allocations we use to make this portfolio, the different percentages to put into each investment allocation, and of course, I'll share with you the outcomes. So what did Charles Schwab find by creating this portfolio template, and by doing the testing of this type of portfolio, what did they find to be the historical average returns of this specific allocation? So I'll share that with you. I look forward to you watching. Thank you so much for your attention. I'll talk to you soon. Hi everyone and welcome. This is the Real Sense podcast where we bring you bite-sized advice to help you make real sense of money, the markets, and helping you create a legacy for you and your family. Wherever you may be, however you may be listening, thank you for making us part of your day. In today's episode, I'm going to share with you how to create an aggressive portfolio for yourself. I'm your host, Isaiah Rial, financial advisor with Laguna Wealth Advisors. Let's go ahead and get started. So as an intro, in today's episode, we're going to work together to create an aggressive portfolio for yourself if this fits your situation. So now we are going to create the highest risk type portfolio we can make for ourselves. In this episode, I'm going to share with you via a Charles Schwab template how to create a base portfolio for yourself for an aggressive portfolio. I'm going to share with you the 5 key items that we need to build this portfolio and examples of investments that possibly you can use to help create this portfolio for yourself. I'm going to share those exact percentages of how much to put into each investment, as well as who should be investing in this portfolio and possible outcomes that you may receive by investing and creating an aggressive portfolio for yourself. So let's go ahead and get started. So who should be investing in a portfolio like this? Again, this is going to be an aggressive portfolio. So this is the riskiest and aggressive gets when investing. Odds are is the person who's investing in this portfolio, if this fits you, should be long-term focused. They should not be short-term focused. They need to be thinking years, decades, 20, 30 plus years from now. This type of person is going to want high growth potential and they don't need current income at all. Their main focus is going to be, let's grow this money in the hopes that 20, 30 plus, 40 plus years from now, that this money grows in value to help me build up a net worth, help me build up a nest egg for myself. We're going to be investing pretty much all of this money into equities, stock and stock investments. We are getting extremely aggressive here. Also, this is an important question to ask yourself is, am I willing to lose some or all of my money? The reason I say that is because this is an extremely high risk type of portfolio. This is the most aggressive that we get when it comes to investing. So you have to know too as well that stocks fluctuate up and down. There's volatility in the markets. So there is a possibility that you may lose some or all of your money. If you can stomach that and you're in it for the long term in the hopes of taking on this risk so that 20, 30, 40, 50 plus years from now, your hopes are by taking this risk, you're going to be rewarded with those higher returns, then okay. And then you have to make sure that this fits your needs. This fits your time horizon, your financial needs, your financial goals, and your investment strategy and your risk tolerance. So you have to make sure of those before you decide to invest in an aggressive portfolio. So how do we build this portfolio? How do we create an aggressive portfolio for ourselves? If you've heard my other episodes, we built a foundation through the bonds, through the cash investments to provide us that stability for a portfolio. In this case, that's really not going to be here. We're going to put 5% of our overall money into cash investments and that's it. None of the money is going to be invested into bonds, into fixed income. All of it, 95% of our money is going to be invested into equities. So again, we're going to be all in here with the equity side. We're willing to take on that high risk for the potential for high growth. So let's start here. The foundation for this portfolio is going to be on the equity side. So we're going to put half of our money, 50% of the money, into large cap equity. So large cap equity, examples of that are companies such as Apple, Amazon, Microsoft, Johnson & Johnson, JP Morgan. Those are examples of the blue chip type of companies, the large cap equity companies. The companies in this category all have a market capitalization of 10 billion or more, so they know what they're doing. They have a bunch of outstanding stock with investors. Odds are, as these companies provide very stable returns, they're not going to give you high returns, but they're going to provide you very stable returns. And you can see that through the historical data of these companies. In addition, they may provide you dividends. In this case, odds are, if the option is available to you, you may want to reinvest those dividends back into buying more shares of whatever investment you're looking to invest into. But that's going to really be the foundation of this portfolio, is 50% of the money is going to be in large cap equity. The other 45% of our money, we're going to be a little bit more creative with that other 45% of our money. We're going to invest a quarter of it, so 25% of our overall money, we're going to invest it into international equity. That's going to allow us to do a few things. Number one is it gives us the opportunity to be able to invest into companies in areas around the world that we wouldn't really be able to have the returns and access to here in America. Throughout history, and perhaps in the future, but at least throughout history, we've seen that there's been other markets out there around the world that have performed perhaps higher than the US markets. And also too, as we know, the companies are here in America, so we have access and availability to perhaps, if it's available to us, invest in those types of companies. Vanguard, they're one of the largest institutional money managers in the world. They came out with a study, and they saw that through historical data, they found that the developed markets around the world provide extremely similar returns to what you can receive here in America. In addition, it lowers our overall risk because we're putting our monies not just in one place of the world and not in one type of investment, but we're putting it into different types of investments. We're diversifying. And also too, it helps us to lower our overall risk because again, not putting all of our eggs in one basket. We're not going to put all of our money in just into the US equity. We're going to put it into different areas. And the last 20% is we're going to put into probably our biggest growth potential, but also to our highest risk investment. And that's going to be our small cap equity. Again, these are going to be companies like Ancestry.com, Papa John's, Buffalo Wild Wings. These are small cap companies, meaning that they're not startups, but they've been able to grow their business very successfully. But their main focus is scaling. They want to scale their business. They want to grow to become those blue chip type of companies. But the reason why they're high risk is because, of course, not everyone can become Amazon. Not everyone can become Walmart. There's companies that aren't able to scale and grow their business as they like. So there's risk involved in investing in these types of companies. Of course, though, if they're able to succeed, there's extremely high potential for them too as well. So because of that, we're willing to take on this risk for a long-term period of time in the hopes that, again, 20, 30, 40, 50 plus years from now, that risk that we're willing to take with the small cap equity will provide us that reward of higher returns down the line. We're willing to take on that risk for the potential for higher returns. So as a summary, we're building this portfolio. We're going to be all in. We're going to be aggressive. We're putting 95% of our monies into equities. 5% is going to be put into cash and cash investments. It's going to be CDs, high yield savings accounts. Savings accounts are going to provide a little bit of preservation of our money for us. The bedrock of this portfolio is going to be that 50% of our money invested into large cap equity. Again, those are going to be in those blue chip type of companies. They're going to provide us stability in the sense that they typically tend to provide very solid returns. Also too as well, they may provide us dividends. If the option's available to you, perhaps maybe you can reinvest those dividends and buy more shares of whatever investment you're looking to invest into for your specific portfolio. 25% of our money, so a quarter of the money is going to be invested into international equity. Again, the international equity is going to do a few things for us. It's going to help us lower our overall risk for the portfolio because we're putting our monies in different areas around the world, not just in America, but abroad. It's going to help us diversify our money. Like I just mentioned, we're putting monies into different areas, not putting all of our eggs in one basket. And then also too as well, it gives us the opportunity and potential to see returns and to invest in companies that aren't here in America. And that final 20% is we're going to put our highest risk and potential for highest growth investment into small cap equity. Again, that's going to be extremely high risk investment. However, since we're long-term focused, our hopes are is that by taking on that additional risk, that 20, 30, 40, 50 plus years from now, that risk that we're taking will provide us and reward us with higher potential returns. That creates the portfolio. That's the makeup. That's the foundation for an aggressive portfolio. Again, this is a template provided by Charles Schwab. Now next, let me transition into outcomes. So what typically tends to happen by investing into this type of portfolio? Again, an aggressive portfolio is going to be for a long-term investor who wants high growth potential and they don't need current income. And again, this is an important thing to know, is that this type of portfolio is going to have year-to-year volatility in the value of your portfolio in exchange for potentially higher long-term returns. So we're going to see some volatility. We're going to see some swings in the market, some ups and downs, and most likely we will see some ups and downs in this portfolio. But again, we are long-term focused and we're willing to take on that additional risk in exchange for potentially high long-term returns. Charles Schwab, of course, does a study and they do historical data. And they found that, and these figures are provided by Morningstar, and they got return figures from 1970 to 2014, and their compounded annual average returns, and they found the minimum and maximum annual total returns of hypothetical asset allocation plans of this exact type of portfolio, with these 5 key areas and the exact percentages. And they found that from 1970 to 2014, with compounded annual average returns, that the average annual return of an aggressive portfolio averaged about 10.3% per year on average. The best case they saw was that it provided 39.9% return, and the worst case in a year they saw that it dropped 36%. So again, more than a third of the portfolio value dropped in a year, so the risk is there. However, that potential is there too as well. So that's the type of outcomes. This helps you provide just an outline, an idea, a perspective as to what type of returns that this type of portfolio has seen throughout history. So again, this is from 1970 to 2014. So everyone, that is how we build an aggressive portfolio. And again, this is just a foundation. This is a template that I want to share and give to you. If you want to make adjustments or fine tune it, then by all means, you definitely can. I just want to provide the framework for you. If you have any questions, have any thoughts, please feel free to leave a comment for me in the comment section. I would love to hear them from you and hear your feedback. If you haven't done so already, please like us on our social media pages. We're on Facebook, we're on Instagram. We provide some great content for you there too as well. Everyone, I look forward to talking to you soon. Enjoy your day. Have a great day. We'll talk to you soon. Take care.